And welcome again to another edition of Market Analysis for today, January 26th. I'm Giovanni Betancourt, analyst, trader, and educator for Vantage Markets. Thursday's fourth quarter growth figures were incredible. The economy is looking less like a Goldilocks story and more of a Cinderella. And it isn't a question of being too hot or cold, it's an impossible dream coming true. Wall Street and pretty much everyone else got the economy all wrong. From widespread prediction of recession at the start of 2023, right up to the underestimating growth at the end of the year. And consumers are still spending. Unemployment remains low. And today's fresh figures from the core personal consumption expenditures index, the Federal Reserve's preferred measure, add more color to the picture. It's all the more remarkable that growth has been so strong, even as inflation rates have come down substantially. But this dream come true also presents a problem for the Fed. You see, a cycle usually works through the following steps. The economy gets too hot, inflation accelerates, and the Fed raises interest rates. Then the economy cools down, perhaps even contracting, and only after that is inflation brought back under control. See the problem? The biggest and fastest increase in interest rates in a generation hasn't crashed the economy. And because monetary policy works with a lag, it's too soon to say interest rates have had much of an impact in bringing inflation down. Smoother supply chains and lower energy costs have done the heavy lifting. It's worth noting that the rest of the world hasn't been as lucky. Europe is on the brink of a recession and inflation is still higher. Japan is still struggling to escape deflation, with the latest inflation numbers coming in lower than expected. China's economy is feeble and requires more stimulus. And Fed Chairman Jerome Powell and his colleagues will examine this conundrum of strong growth and slowing inflation at next week's rate setting meeting. And they don't actually know any more than investors do. So on balance, that probably means that they will be more reluctant to start cutting interest rates than traders expected. So what is a trader to do? Right? So you're trading CFDs, right? Contracts out for difference price. The difference in price. We've been yesterday, even though we did have a nice rally to the upside, all of that momentum died out real quick, and we actually closed on the red. Today, we continued that movement to the downside throughout the London session. Now, as we about to open, we should see if that will continue. Okay. Now, would you say, okay, go with the flow, go with the trend? Well, the trend is going higher. Okay, that's for sure. Now, what can we use? What tool can we use? Let's say we could use the Fibonacci retracement to say that to measure this same movement and see how much it has retraced, or should you want to just measure this small movement? Well, if you want the small movement, then you're gonna get much data. See, but if you grab the whole enchilada, boom, then you have a better view. So if this is gonna be a retracement, a pullback, a continuation of this pullback from this high, because this is 17,800, nice round number, psychological number. So if that's the case, the using of this tool, a ratio that 0.38% could be that that level where if this is going to continue right away, then this is the place where you to look at. Now, using the Fibonacci golden ratio, then that will be the 0.61, right? Then it should retrace all the way down to this level before it could continue to move higher. The 0.50 is not a Fibonacci number, so I don't mention it. But a lot of trades have happened before in this area. A lot of trades has happened because what I've seen in trades is that those retracements are about 0.38%. So when you start eyeing that, is that 0.38%, and you use the tool, you show you where about you're eyeing that 0.38% will be. So that number is where we keep an eye on, because that's where we see if there's going to be action starting to the upside, because we are in an uptrend. Okay, so that's that. And then you can use that for for the other any other obviously assets. So as far as for the S&P, well, yeah, the same token goes. Earlier we were in the green. Now we are trending lower. So it could be a just moment to take some money off the table. Also, the Dow making a covenant of congestion right here. This is a breakout. This is a setup for a breakout. Equal highs, equal lows, mostly. But you see, this is a covenant of congestion. I call it a breakout. It's a minute either to the upside or to the down, whichever way. Crude oil, even though it opened with a small gap up, it has been closed. So it did fluctuate towards the 76 handle, flattish, but it's recovering. But let's see if we will find some more buyers to bring it, make another attempt at 78, or will it just stay here and idle around 77? That could be also another. It's the weekend, a lot of people want to leave trade over the weekend, so actually it could be selling not gas, selling that gas. Gold, gold. I think gold is gonna stay steady around this level, around 2020. Silver, I think, is also gonna stay where it's at. It's not gonna be too much of a fluctuation. I mean, all right, so it could continue to trade lower towards my support level. So I favor that selling. Copper. Oh, copper, after having such a nice rally on Wednesday, it's just stuck now. Just really, let's see. This could tell you that, okay, no, this is going to be a change of direction. So we'll be start selling, but you don't know. Just make sure you are on the right side. Then we have Bitcoin. Bitcoin finally has come back above 40,000. Now it's trading 41. Let's see if it reaches 42,000 today. Then we have the euro. So the euro looking to say north of 108.5, and the pound north of 126.5. See if it'll hold those grounds, and that will happen if we see the dollar index just plummeting, just dropping towards 102.5. Let's see if that happens. All right. Well, thank you for watching. Have a great weekend, and I will see you guys on Monday.